Three stock picks for May. I've been looking at these three companies for a while now, and I think May is the best time to start buying into them for a few reasons. The first one is because the third and fourth quarter, we're going to look at better seasonality for each of these companies, as well as I think this is a good time related to their stock price. So the first one I chose is a really stable company, and it has high financial strength, so this makes it really low risk. So if anyone is on the lower risk side of investing in companies, then this is a good pick for you. The second one I pick is a little medium risk, but it's still a strong company because they have a growing company, which makes them higher risk, and they also have revenue right now, and this puts them in a good position to invest in, and it's not as risky as most companies which are growing, but it's still a good pick. The last one I chose is really high risk. This is because their revenue is speculative, and their stock price is fairly new to the market. Okay, so let's get into it. The first one is UPS. A lot of people miss UPS, and UPS is really popular. I mean, I see a UPS truck every day, and I'm sure everyone has used UPS at least once. So just for that reason, I think it's a really universal company that everyone can relate to. And so because they have a really good financial background, this means it's a good investment. And let's look at that. So right now their market cap is $92 billion. They're a really strong company. That's one of the top companies in the world. Right now, I think they're trading at a discount. They're trading at $106 compared to the 52-week low of 100 and a 52-week high of 120. And if they're trading at a discount right now, this is a good time to buy it. And I would buy it right now because of the dividend they pay. And they pay a really high dividend at 3.15%, which is their forward dividend. And if I pay, $106 and I get this dividend, I'm going to make my money back real quick. And this is what their price to earnings is. Their price to earnings is really low at 16.5. So I'm going to be making my money back on really quick with UPS, as well as UPS is really financially stable. On a value line, they have a ranking of an A, and the highest you can have is an A++, and this is on financial stability, so this is a really safe company. Their safety rank on value line is 1, which is the highest rank you can have, and this also makes it a really low risk and safe company to invest in. Some of the other values that also make it are a low beta, which is under 1, and beta measures how the price of the stock moves related to the stock market. So if the stock market goes down, UPS won't go down as much. And it also works the other way. So if the stock market goes up, well, UPS won't go up as much, but I'm not worried. I'm not really paying attention to the stock market overall because I can't time the stock market. I can time when I buy in and when I sell out. And if I'm buying in at a discount, I think I have a higher potential to sell at a higher price. So let's look at their really good numbers right now. Like I said, low PE, 16. So they have a higher PE ratio. They have a lower PE ratio than Apple. They also have a higher dividend than Apple. I'm just using Apple as a comparison. It's not really a good comparison, but Apple's a really financially stable company. That's the comparison I'm basing it on. Another good measurement is return on equity, which is what I based each of my stock picks on, because return on equity is basically showing your return on an investment if you got all the earnings on the shares you earned. It doesn't work like that, but their return on equity is 235%. That's super high. Just on that value alone, if they're a stable company, well, I'm going to invest in them. Their revenue is $60 billion, and they're making a lot of that right now as net income. So 60 billion revenue is turned into 3 billion in net income. Most of that cost is actually going to the administrative costs of like running the UPS stores and running the UPS trucks. Most of that cost is not actually going into the cost of the revenue. And that's good seeing because they can always drive the administrative costs lower as they optimize their business. Another great value to see is that their earnings per share trailing 12 months is 3.8. So they're earning a lot of money, and I like seeing companies that earn a lot of money that are stable and have low risk. Now onto the negatives. So UPS does have some negatives, and it looks like their debt is really high. at 16 billion. And this is about 20% of their market cap. And this, makes me wary in investing it, just because I don't like seeing debt. Both you have to pay it back, and interest costs you a lot usually for companies. But they're paying a dividend, so as long as they pay me the dividend, well, I'm happy with that. And that's why I picked UPS. The second one, which is what I made a video on, is Netflix. And I think Netflix is awesome. Of course, personally, I use Netflix, so I am biased, I think, just on that value alone. But looking at it as objectively as I can, I think they have a really good potential in the future. They're one of the top TV companies right now, top 5 by market cap. They have this high stock price, I think, because of the amount of members they have, which I don't think some people take into account, because you can't quantify the value of members. But with 100 million members, this makes the stock very valuable, especially in the future when those members have a direct correlation to revenue. And let's look at the revenue. The revenue is 10 billion almost, and this is great to see, because they're taking in a lot of debt, which I'll talk about. But so 10 billion revenue, only 337 million net income. And why is this? This is because they're reinvesting in the company, and they're a growing company. And because they're reinvesting and retaining all their earnings, their PE is going to be super high, which isn't a really attractive value. And this is why I put it in the medium risk section of my stock picks. Another good value for them is they have good return on equity. It's at 12.75%. And return on equity is just important to look at as an investor. It shows you how much the company earns compared to how much you've invested in them. So with 12.75%, well, right now that's a positive earnings. And so that's why I think it's a good investment, regardless of the risk they might have. They have really high revenue, and also their earnings per share is a good amount at 77.77, so 77 cents. On to some of their negatives. They have a lot of debt, and they're taking on debt every day. Well, actually not every day. They're taking on debt every year. And why are they taking on debt? Well, I think they're taking on debt both to increase their library size and increase the amount of members they have. This is why I would invest in Netflix, because they're reinvesting a lot of money, and they're taking debt in to get more members and also increase their library. And their library is basically the inventory they sell to customers. These are both things that improve the company and also make it much more valuable. The membership is the most valuable part of Netflix. With 100 million members, I think this is what drives the stock price so high. And with that amount of members, well, I'm really happy in making an investment in that, because the membership amount is direct correlation to the revenue. So let's summarize Netflix real quick. They have good ROE. They have high revenue. They have a lot of members, more than most. They're a growing company. Some of their negatives are they have high debt, and they're retaining all their earnings, as well as taking on new debt. This is why I put it in the medium risk, because we don't know how that debt is gonna really pay off in the future, or if it's a good investment. But we'll see. And I'm willing to invest in it just on the basis of the high membership amount. Now let's get into the last one. The last one is Snapchat. And, I'm going to play Snapchat because they just IPO'd. So no one knows really where they can go. One of the most valuable thing about them is that they have 150 million active users. And this is why the market cap is so large, because those active users can be directly correlated to the revenue they have, depending on the route they go to bring in revenue. And this is what makes it really high risk, because we don't know how they're going to get their revenue, and they don't have any substantial revenue right now. And so you're betting, at the roulette table, really. And right now it's really cheap at $21. And so this is why I'm willing to do it, because if I'm betting on a social media company with 150 million active users, I'll be happy either way it goes, just because I took the opportunity that it might have presented itself. With Snapchat, I actually I didn't buy equity. I wrote covered puts. And by selling puts on them, if they do drop in price, I will get them at $15. And I'll be happy at getting Snapchat at $15, because if they manage their company well, and if their company is successful in the future, then the stock price is going to be much higher than $15. But keep in mind that it's really high risk and it's really speculative. So any low risk investors don't invest in it, and also any value investors, I wouldn't invest in it. Keep in mind that I don't recommend to buy any of these or make any positions on these, just because these are what I'm doing. These are my stock picks, and you can take that information of what I said and make a decision based on that. So if you liked the video, hit the like button and also subscribe, because I post early in the morning when the stock market opens or after the stock market opens. Also leave a comment saying what you think about each of these companies. There's some things I didn't look at, so leave a comment, just talking about it. We can have a conversation with it. I post about stock education. I'm planning to do some financial videos in the future, as well as more investment videos, so look out for those.